Hey there, it's Collin Fett, your agent, here with our lender, Gavin Crandall, here to talk about our monthly lender update. So, Gavin, thanks for joining us. Excited to talk on the Zoom. A couple of things we're going to talk about today is COVID. Obviously, COVID's on everybody's mind still, but what's going on?
Everybody's dealing with COVID right now, right?
Yeah. So, yeah, what's going on with FHA loans and COVID? I'm hearing some stuff.
So, yeah, some really, really good news. So obviously, throughout COVID and throughout that pandemic, what we saw was underwriting got tighter, right? And underwriting got tighter, and credit got a little bit harder to get, and kind of a perfect storm of basically a little bit more challenging underwriting qualifications because of COVID, right? People were losing jobs, people were being furloughed, economy was kind of going down, right? And so what's happening now is with things starting to move, vaccines, stimulus talks, all that stuff. Basically, the loan performance with FHA, investors are kind of being a little bit more comfortable with where things are at, right? So now what happened was FHA during COVID actually increased the minimum credit score to like a 620. So you had to have a minimum credit score of 620 to be able to qualify for FHA. Prior to COVID, Fairway, we were actually able to go down to a 580 credit score, okay? Now, with a little bit of rollback and with loan performance being where it's been, we've announced that we're actually going back down to 600. So kind of in the middle there, but that's really, really good because essentially if someone was maybe at a 605 or a 610, now they're qualifiable, right? And before, from basically March until now, it would have been a difficult time to get them qualified. So very, very good news. Obviously, loan performance is a big thing there, but obviously economy and everything else that kind of spurs and goes from there. But it's just great to see because, we obviously want to help any way that we can. And if that credit score, it's really, really tough to build up, but it takes one misstep to knock it down. And sometimes people fall that 600 mark. So
I've definitely seen that too, where it was harder there for a little while. So basically you're saying they're kind of opening the doors back up where they're letting more people come in.
A little bit. And so we're not clearly back to where we were before COVID.
Right. They're like half open. The door's like
right. Yeah. We're in a small door getting back to it, but really exciting to hear that, just because, like I said, that climate of the lending from March to December, it was a little tight. And so this is positive because we can do something with that for those borrowers that maybe fall from that 600 to 620. And now they have some options.
Right on. Well, cool. Okay, so then the question I always get is rates. They're down, they're low right now, or they're going up. The news is going to say, if they go up a 0.25%, the world's on fire. If they go down, it's the lowest rate ever. So what's going on with rates? I know you're not a guru. What do you predict? Coming into the spring, got a lot of people looking to buy, in the next couple of months.
It's a crazy. I think you get this question a lot. I think it's on a lot of buyers' minds, right? And we receive it probably 17 times a day. And so the quick answer is that right now, just where rates are positioned, they're record lows, right? So it's 2.5 to 2.99. Obviously loan programs have an impact, credit scores have an impact, but that's kind of where they're at. And so what we're starting to see is mortgage rates are dependent on the 10-year Treasury bond. Okay, and so when we hear on the news that stock market's going down or up, mortgage rates has nothing to do with it, right? And so it never fails. Like when the news is reporting, hey, the market's going down, you need to check on your mortgage rates. No, they've been positioned there, right? So part of it's educating the clients of just letting them know, hey, the news is great, but it's also not. I don't think they're being fully transparent on what's happening. So if you look at the data, so the 10-year Treasury bond, basically what happens is it finally went over 1.0 for the first time since last March, okay? And what that essentially means is for the last 6 months, it's been down to 0.6 to 0.7 to 0.8, and now you're finally starting to see that rise a little bit. So as the Treasury bond continues to go up, then rates will start to slowly move up. And again, you're going to hear that, the rates are moving up because the Treasury bond's going up. Let's have a conversation about a little bit of having, essentially knowing where things are at, right? Even if they go up to 2.99, it's still historical lows. right?
Right.
And
There'll
even
be the Chicken Littles out there that says
right,
rates are going up and it's crazy, but relative
correct.
to
Yeah,
the last
the
few
sky
years.
is falling because the
Right.
rates are going up. You know, if you look at a transaction where, say, it's a $150,000 house, right, and you're looking at a rate of 2.75, and now it's at 2.99 or 2.875, that's a difference of about 20 some dollars a month. You know,
Right.
so yes, rate is important, and yes, we got to do that. But just know, you know, things are going to stay relatively where they're at through this year. You know, there's going to be ups and downs. You know, so next week it could say, you know, this is not a it's not a political thing, but you know, that had an impact last week and 2 weeks ago when things were happening, right? The rates got affected by that. So to say that it's not going to move, that's not going to be fair, because it's going to move. Watch that treasury bond and just know that if it does move, the sky's not falling, everything's going to be okay. And we're still talking prior to COVID, right? Record lows were in the threes, or mid to low threes, right?
Yeah.
We're in the mid to high twos. I mean, it's just crazy. So having relative perspective, I think, is really, really big right now.
And you can lock a rate for what, 60 days?
60 days. Yep.
So,
So you can't lock
if you got a house under contract now, push
Correct.
it out a little ways.
Yep.
They can still lock that low rate in.
What I was going to say is, like, we can't lock a rate until we're under contract. Because, you know, so when you're getting rates with different lenders, they're saying our rate is this. We can estimate where they're at, but you're not going to know, because it could be a situation where rates are here today, tomorrow something happens, right? Treasury bond maybe goes to 1.2, right? So then the market has to adjust to maybe it's a 2.9 or 3% rate. Well, then everything that we just thought before is now thrown out. Again, is it a big deal? No, but just wanted to kind of express that as we hit the spring market, it's kind of something to keep our eye on, you know, as we get into the busy season with it.
Right on. Well, cool. Thanks so much for joining us, Gavin. We always appreciate it. We'll see you next month on our monthly update. As always, if you got questions about the real estate market, we'd love to help. Gavin's obviously a huge resource when it comes to lending, and our pick of choice. So thanks so much and have a great day.
Thanks, guys.